When the market crashes, most beginners don't lose because they chose the wrong ETF. They lose because they panic at the worst possible moment. And if you've ever thought, what would I actually do if my portfolio drops 10% or 30%? This video is for you. Because a market crash does not test your intelligence first. It tests your behavior. And that is where most people fail. Welcome back, or welcome for the first time. This is GrisiekCapital, and this channel is about building real wealth the calm, structured way, without hype, noise, or fake certainty. This is week 4 of the Global Wealth Foundation, and this week is different because now we move from structure to behavior, from what to buy, to how not to destroy yourself when markets get difficult. If you want practical long-term investing education without panic and without nonsense, subscribe so you don't miss the next lessons. And if this topic matters to you, leave a like. It helps this series reach the right people. Now let me say something clearly. A market drop always sounds easier in theory than it feels in real life. When markets are calm, people say things like, "I'm investing for the long term. I'll just hold. I'm not emotional." But then the market drops, and suddenly everything changes. Red numbers, bad headlines, fear everywhere. People online saying this time is different, and what used to feel like a simple plan suddenly feels personal. This part matters, because beginners often think the challenge is knowledge. But during a crash, the bigger challenge is emotional pressure. It's one thing to say, "I can handle volatility." It's another thing to watch your money fall and still stay calm. So let's start with something many beginners eventually experience, a 10% drop. Now listen carefully. A 10% drop does not automatically mean disaster. It does not automatically mean your strategy failed. It does not automatically mean the world is ending. And it does not automatically mean you need to do something dramatic. In many cases, a 10% drop is simply part of investing. Not fun, not comfortable, but normal. And if you're new, I really want you to hear that. Normal does not mean pleasant. It means expected. A lot of beginners enter the market with an invisible assumption. As long as I invest well, maybe it won't drop that much. That assumption is dangerous because markets do drop. Even good assets drop. Even diversified portfolios drop. So the question is not, will it ever fall? The question is, what will I do when it does? So what should a beginner actually do when markets drop 10%? Step 1. Do not turn temporary fear into permanent damage. That means, do not panic sell just because prices are lower. Step 2. Return to your original plan. Why did you invest in the first place? What was your time horizon? What structure did you choose? Did the businesses disappear? Did your long-term logic break? Or did prices simply move? Step 3. Reduce the noise. Because during drops, content multiplies. Hot takes multiply. Predictions multiply. Fear spreads fast. And if you keep feeding your fear, you make disciplined behavior harder. Step 4. Zoom out. If your horizon is measured in years, a short-term drop should be interpreted differently than if you needed the money next month. This is where many beginners go wrong. They build a long-term portfolio, then react to it like a short-term trader. Now let's talk about something much harder, a 30% drop. Because this is where theory gets exposed. At -30, people don't just feel uncomfortable, they start questioning everything. Maybe I was stupid. Maybe I started at the worst time. Maybe I should have waited. Maybe I should sell and come back later. And this is where panic becomes dangerous. Because a 30% drop doesn't just test your portfolio, it tests your identity. It asks, did you actually understand what you bought? Did you actually accept risk before it arrived? Did you build a real plan? Or just a plan that felt good during green markets? And honestly, some people only discover their real risk tolerance during losses, not during gains. during losses. So what should a beginner do at -30? First, stop making emotional decisions in a high-stress state. You do not need to solve the entire market in one night. Second, recheck the structure, not the fear. If you own a broad, diversified long-term portfolio, a severe drop can still be painful, but it does not automatically invalidate the structure. Third, separate price from value. A falling price is not always a broken investment thesis. Sometimes it is fear, sometimes recession risk, sometimes liquidity stress, sometimes broad panic. Fourth, keep liquidity in mind. If you are forced to sell because you invested money you needed soon, that is a planning problem. If you are not forced to sell, that gives you more room to behave rationally. And fifth, remember this: selling after a large drop may feel like relief in the moment, but very often it simply locks in the damage. This is one of the most important lessons in investing. Panic selling destroys wealth because it turns volatility into final loss. A drop on paper is painful, but selling into fear can make that pain permanent. And beginners often do this in 2 steps. Step 1, they buy during comfort. Step 2, they sell during fear. That is the opposite of disciplined investing. And this is why behavior matters so much. Because even a good portfolio cannot protect you from self-sabotage if you keep reacting emotionally to every major drop. Ask yourself honestly, do I have a system, or do I only have confidence when prices are rising? So let's make the contrast clear. Emotional investing asks, how do I feel right now? System investing asks, what was my plan before the emotions arrived? Emotional investing reacts. System investing refers back to structure. Emotional investing chases comfort. System investing accepts that discomfort is part of the process, and this is where adult investing begins. Not when you buy your first asset, but when you stop making your portfolio answer to your emotions every week. This is also where DCA becomes easier to understand. Dollar cost averaging is not magic. It does not remove risk. It does not guarantee profit, and it does not protect you from all bad outcomes. What it does do is create a process, a repeatable system. So instead of asking every month, is now the perfect time? You keep investing according to your rules, and that can be psychologically powerful during uncertain periods, because rules reduce emotional improvisation. A lot of beginners think the goal is to avoid every crash. It isn't. The real goal is to survive them, because long-term investing is not built on perfect timing. It is built on staying invested long enough for productive assets to do what they do over time. And yes, timing feels smart. But structure is stronger, because most people cannot consistently predict bottoms, tops, fear cycles, recoveries, and sentiment shifts. So instead of trying to dance perfectly around every drop, a better beginner question is, how do I build something I can keep holding through them? Now let's close with the rule that filters out a lot of bad decisions. If you cannot realistically hold it for 5 years, do not buy it for 5 minutes. That line matters because it forces maturity. It asks, are you buying this because you understand it, or because you want short-term excitement? Because if your conviction disappears the moment volatility arrives, you may not have had conviction, you may have had optimism. And those are not the same thing. So let's bring this together. A 10% drop is uncomfortable, but often normal. A 30% drop tests more than your portfolio. It tests your behavior. Panic selling destroys wealth because it turns temporary pain into permanent damage. System investing is stronger than emotional investing. DCA is useful because it creates process. And time in the market matters more than trying to perfectly time every move. So if you want to survive, crash is better. You do not need more panic, you need more structure. If this helped, comment system. And if you know someone who panics every time markets move, send them this video. Thanks for spending this time with me. This is GrisiekCapital, calm, structured, long-term investing education. Next week we move into global asset classes: stocks, bonds, real estate, gold, cash, and crypto, and what each one actually does inside a portfolio. Until then, stay patient, protect your behavior, and ignore the noise. I'll see you in the next one.